Jamie Dimon speaking at a conference sponsored by J.P. Morgan out at UCLA, addressing, giving sort of his take here on the battles between the United States and China, whether or not it's a trade war and what its impact is likely to be. Here's what he had to say.
A trade war is that people stop trading with each other and that they immediately change supply lines, and that will rattle the global economy. There's no question about that. That is a lot of movement around the world. Then you're going to have foreign trading partners taking actions, and there I think you basically can offset. It could cause a recession.
Jimmy,
but it's not a war. Okay, a war is people pick up guns and people die.
So Dimon there saying it's not as serious as a war, obviously, in which people are actually shooting at each other, but also laying out some of the serious economic consequences that can come from a trade war. I think the nuance here that we need to find out a little bit more information on is whether Dimon thinks that we are in a trade war right now or whether this is headed toward a trade war, and whether or not he thinks that the current situation is one that could cause a recession. So something to monitor there in terms of the comments from J.P. Morgan's Jamie Dimon, Melissa.
All right, Eamon, thank you. Eamon Javers joining us from the White House. I mean, in terms of tariffs, we could get another round of tariffs on the remaining imports from China. The tariffs that are already in place that are at 10% could move up to 25% come the new year. So from here on out, I mean, unless there are developments at G20 in Argentina, it's a pretty slippery slope.
The problem is this is not a trade war, and forget the terminology because it's obviously not a war with guns, but it's not a skirmish, and in fact, this is a geopolitical standoff. This is not your father's trade war. This is absolutely about geopolitical dominance of technology for the next century or beyond, and there's no reason why either side is going to let off quickly. I think that's why you have to be a bit concerned here, and that's why I don't think when we see headlines like we saw yesterday, that's why I think this market is reacting every time.
I mean, the yuan hit the lowest level that it has in, 10 years now?
Absolutely. Overnight. And the Chinese economy is slowing. I mean, it was slowing before this, right? So the problem here is the uncertainty. We don't know how long this is going to go on. Initially, everybody said, hey, it's going to be short. This is a negotiating tactic. We're going to come to agreement. We've come to agreement with China, with Canada and with Mexico. We'll come to agreement potentially with Europe. But then it comes down to China, and that adds the uncertainty. And how much is that going to slow the U.S. economy?
Again, I keep coming back to it. We say when our president is ready to make a deal, there'll be a deal. I don't know if that works that way. I think it's more that when the Chinese are ready, they'll make a deal. And I don't see any reason for them to be real, understanding that their market has gotten schmeizled. But I don't know if that plays into this calculus.
But it is about intellectual property. So to Tim's point, there's tariffs around this whole bigger issue that it's impossible to really sort of mend it the way that Canada was mended or Mexico was mended. So it is going to be difficult, but I do believe they're going to get something done, even if it's baby steps.
I mean, in the meantime, we're hearing, and we talk about this all the time, commentary on the corporate conference calls about the impact, the negative impact on tariffs, holding back of CapEx, et cetera. Have the data changed? I mean, that's what the Fed always says, right? The Fed is data dependent. And we always have this debate, but I think as the markets grind and there's all this volatility, it's because of this. Has the data changed? Well, is that considered data in the eyes of the Fed that has changed?
So potentially, here's what you have to understand. We talked about the consumer a little bit, but these tariffs, you know who pays it? We do. So the president talks about billions of dollars coming into this country. What happens is our companies have to pay a higher tariff to bring it in. They pass it on to consumers. So is that reflected in the data yet? Probably not. Maybe that's what the stock market's looking for. But I would say that is something, as long as it continues, right? If we have this prolonged trade skirmish or whatever we want to call it, that will be reflected in the data. Things will be 25% higher.
I think there's a deleterious effect long term here, which is that you actually see, look at U.S. pork farmers. There will be pork bought from other parts of the world, and that business may not come back dollar for dollar. I'm not saying it's going to go away forever. U.S. steel companies on average, whether it's AK, whether it's Nucor, whether it's U.S. Steel, with steel prices at all-time highs, are down 49% on average across the board since these tariffs were announced. How are they doing? I mean, so you can't tell me that businesses aren't being impacted right now.
It's interesting. Deleterious is an excellent high.
5.
It's 5
syllables. We've really been. Are you okay? Are you holding up?
No, I'm doing it. I'm enjoying. I mean, I just said big words all night long. It would be fantastic. It would be a great show. We got to go.
It would actually be a good show, but
it would be an okay show.
It'd be a show.
It's interesting. If the Fed does, let's just say the Fed takes a pause. What does that mean for the U.S. dollar? Maybe the dollar then gets smacked. Our buying power as consumer goes down. maybe
More
that's
inflation.
not necessarily a good thing. I mean, there are a
Well,
lot
the market does rip. Knee jerk.
knee jerk, maybe.
Knee jerk, the market rips.
More inflation, more Fed.